Retail trading education typically revolves around a single directive: wait for the price to clear a resistance level, confirm the trend, and then enter. This strategy offers a sense of psychological security. Waiting for a visible move means buying into a trend that has already proven its strength. However, this approach ignores the structural conflict facing the institutions that actually drive market direction. Their sheer size makes standard retail entry methods impossible to execute. Look at the mechanics of this orbook. When a billion-dollar position collides with a thin layer of sell orders at a breakout point, the execution price spikes violently upward. The institution ends up chasing the price, destroying their own average entry cost. To deploy massive amounts of capital without alerting the market or inflating their own costs, institutions must operate within periods of low volatility, filling their orders long before a breakout occurs. While retail traders are trained to follow price action, institutions are forced by their own size to systematically build it. This methodical pre-breakout accumulation is quiet, but it leaves a measurable forensic footprint in the market data for those who know how to analyze behavior over price. Waiting for a confirmed breakout often means entering the market precisely when the institutional wealth-generating phase is already transitioning toward a distribution phase. The first forensic parameter is price action. We are looking for a chart that appears completely dead, lacking momentum, volatility, or any significant upward trajectory. Most retail participants view a sideways consolidating chart as a waste of capital. They see the lack of movement as a lack of interest. This chart reveals supply absorption. Downward dips are met by buying power that neutralizes selling without aggressive bounces. This is a specific tactic. By placing a thick limit order block at support, institutions swallow available shares without triggering momentum scanners. This is robotic, disciplined execution. It stands in direct contrast to the emotional, high-velocity buying spikes usually associated with retail FOMO. Sideways price action represents a state of equilibrium, where massive, invisible demand is precisely offsetting the available market supply. Our second parameter is volume. The general market assumption is that high trading volume should always result in aggressive price movement. We look for a specific anomaly, an isolated volume spike where the price remains perfectly flat. Since the price didn't move, scanners ignore it. This vertical alignment shows a massive exchange of shares without a valuation change. This volume-price disconnect indicates a large quantity of shares transferred via pre-planned absorption. One entity quietly fills a massive order by absorbing a large seller. Unlike the continuous churn of market making, these isolated blocks represent a deliberate, targeted acquisition. These spikes are the physical evidence of institutional orders being filled while the price is kept under strict control. The third and most definitive metric is delivery percentage. This is the ultimate tool for filtering out day trading noise. We separate intraday volume from delivery volume. Hollow bars representing quick intraday trades shrink, while solid filled bars representing shares moved into holding accounts steadily grow higher. This consistently high delivery percentage indicates conviction, showing that shares are being held and a position is being built slowly in layers. Consistent delivery tracks the construction of a multi-layered position by an entity with enough conviction to hold through volatility. High delivery proves the buying is structural, separating long-term institutional positioning from casual retail speculation. The final parameter is time. An extended consolidation phase lasting weeks or months creates a significant psychological burden for the average retail investor. Institutions utilize this duration as a tool for liquidity generation. They use the boredom of a flat market to force impatient traders into selling. After months of zero movement, a retail trader is often willing to exit their position just to free up capital for a more exciting stock. Rushing would cause the price to rise prematurely. The institution's goal is to remain in this border phase until their entire position is built completely. The duration of a sideways channel provides the window required to systematically transfer large blocks of shares from impatient sellers to institutional buyers. None of these indicators provide a complete picture in isolation. True behavioral analysis requires layering all four parameters. Here is the unified blueprint. We see price absorption in the top layer, isolated volume anomalies in the middle, and high delivery bars at the bottom, all occurring over a prolonged time frame. When these variables align, they form the unmistakable signature of institutional accumulation. When analyzing a stagnant stock, ask, is the price holding despite low momentum? Are volume spikes disconnected from price movement? Is delivery consistently high? And has the consolidation lasted for months? Identifying this footprint is not a guarantee of an immediate surge, but it is a map of where the smart money is positioned. Professionals do not trade on certainty. They align themselves with the highest probability market structures. There is a significant difference between chasing a visible breakout and identifying the invisible accumulation that makes that breakout possible. To gain an edge, you must look past lagging price indicators and learn to read the behavioral footprint that reveals exactly where capital is moving.